Hey, everybody. Welcome back to Tax Tuesdays. I'm joined by the tax expert, Mr. Ryan Bakey. Ryan, how are you? It's been a while.
It's been a while since we do this. We got to get a date on the last time that we did this. It's been probably a year and a half.
It's probably been, you're right. It's been a long time. So, this is 30 minutes jam packed of tax advice from Ryan. This is Tax Tuesdays. We're going to try to do this every week for you guys. We do travel a lot. So, there could be a recording in there once in a while, but we're going to try to do it live. So, most importantly, as with every other broadcast that I do, please let Ryan and I know in the comments where you're from and start asking your questions because we're on the timer. We're 43 seconds in. We've only got 30 minutes. It's going to be on the same channel. We're in Ryan's Facebook group. We're in my Facebook group. We're on Ryan's YouTube channel. We're on my YouTube channel. And then you can see both of our Instagram handles. Make sure that you're following both of us on Instagram and feel free to DM us there as well if you have any additional questions. So, Ryan, I'm going to kick this off. It's September 10th. That means that literally we are getting super close, like about 100 to 120 days till the end of the year. I'm sure you're getting the same questions that I'm getting a lot. I need to, you and I talk about return on equity audits. Hey, Bill, Ryan, I've done that. I need to sell a property and I need to purchase and also qualify for material participation before the end of the year. What's D-Day for that? What is the absolute drop dead last day that somebody can sell, purchase, and close and not put themselves at risk for qualifying for the 100 hours? For all of like me and you and everybody that can qualify for the 500 hours, let's put them aside. What about the regular Joes that are out there? What's their timing look like?
Yeah, just looking at it from the buy side, I mean, I would say the latest that you could buy a house is probably going to be mid-November, maybe end of November, maybe early December if the property's ready to go and it's already a short-term rental. Because the thing is that you need to have at least two separate bookings of 7 days or less. So that could be two 2-day stays or two 1-day stays, and these stays have to be to not your friends and family, right? These have to be to fair market value, arm's length on Airbnb in order to qualify. And so that's why, that Airbnb most likely has to be ready to go and live by December 1st, I would say.
So, I mean, if somebody was to list tomorrow and then we're looking like a 45-day close, and then in that time interim, they're looking to purchase and another 30-day close, we're right at that deadline, like right now. So you guys do not have much time to waste.
Now here's a couple of strategies, because let's say you are in that situation where you're looking to exit a property because you've gone through the cash on equity audit and you've gone through the life plan and it's telling you to sell, right? We're telling you to sell. It is very important to know that if you have a gain from a rental, all you need is losses from another rental, which means if you're in that ballpark, if you're in that situation, that property actually just needs to go live before the end of the year in order to offset your gain. You don't have to meet the 100-hour rule. You don't have to have so many people stay at your property, because if you have a gain from a property and a loss from another property, those two offset each other. You only need to have the average of 2 days or less stay and the 100 hours if you're trying to offset your W-2 or your business income.
So let's unpack that for a second, Ryan. So I sell a property and I have a $200,000 gain on the sale.
Mm-hmm.
I buy a property and then let's just say I close December 1st and I put $50,000 into the property in renovations, design, upgrades, and I generate zero revenue. How does that affect my $200,000 gain with that $50,000 of investment post close?
Well, some of that $50,000 you're not going to be able to deduct right away. Some of that $50,000 you're going to have to add to the total cost. We actually have a template for our clients that breaks out what you can deduct today and what has to be depreciated over a lifetime. Reach out to us. Feel free to. I'll give you that template. But it's going to be that 50K.
Like a CPA on Instagram. Easiest way, right?
Yeah, just message me on Instagram or Facebook and I'll send you the template. But that's very important to know. We had a client who bought 2 properties before the end of the year, and we specifically worked with her to make sure that the cost that she was putting into the property actually got deducted, because that's the number one mistake that I see flippers, developers, and a lot of people make, is they think, hey, if I put 100 G's in between November and December or October and December, I'm going to be able to write that off against my income. But a lot of the costs that you put into a rental property, those don't get deducted until you actually rent the property out or you sell it if it's a flip. Just
So
had
would
somebody
there
in my
be a
Facebook group
difference
post that.
if I put, $20,000 into add a bedroom, right, versus $20,000 in landscaping or sprinkler maintenance or something that's completely different, correct?
Exactly. Yeah, you want to make sure that you're putting money into things that can be deducted in the first year rather than depreciated over time. If you're looking to save money on taxes, now that's just the money that you put into the deal. Okay, so you had a $200,000 gain on the first property that you sold. You put 50K in furniture and in the new property, but you also have that building basis of the new property that you bought. And so depending on the purchase price, and we talk a lot about that land value, you're almost there to offsetting that $200,000 gain from the first property.
Agreed. Ryan, does furniture get deducted?
Yeah, most of the time furniture is going to be depreciated on a 5-year life schedule. Okay. So, furniture, sofas, anything that's going in a living room, that stuff's going to be written off in the first year that you go live on the property.
So I could put in $50,000 worth of furnishings, furniture, and that type of stuff, and take a substantial amount of that as a deduction without having to go through the full cost seg.
That's right. Yep.
That's where having a smart fucking CPA that understands and has an intimate relationship with the short-term rental loophole is so critical. Ryan, I guess that the next thing that I want to ask you, and I've gotten this question recently, is I think there's some confusion. Can you quantify? Because if somebody can't qualify, material participation, they don't understand what you're talking about, and being able to write this off or take deductions as expenses and that type of stuff without having to do a cost seg. The other alternative is a 1031, right? Can you kind of go through the basics of the 1031? Because I was just in a Facebook conversation yesterday or the day before with somebody thinks all they have to do is spend the basis. They don't understand about the step up and the actual purchase price based on what they sold. Can you kind of just run through the basics of what I would have to do if I sell a $500,000 property and I end up with a $100,000 basis? What do I have to do to spend all that money? What does my purchase price need to be to qualify for that 1031 moving forward?
Yeah, so the 1031, just for those who haven't heard about it before, is where you sell a property that you had a big gain on, and you don't have to pay taxes on that gain. So as long as you put that into another property. Now, there's rules as far as how big the property has to be, how much, the timing of when you have to spend the money, which we can get into today. But the two biggest rules from a financial perspective side, so you got timing rules and you got financial rules. We'll talk about the financial rules. So the financial rules say, hey, whatever price you sell the property for, that also needs to be the purchase price of the property that you buy. So if I sold the property for $1 million, I got to buy at least $1 million property. And a lot of people understand that rule. The other rule that a lot of people don't understand or haven't taken the time to learn is that the equity in the old property also has to be your equity in the new property. Okay, so if I had $1 million property and it was fully paid off and I have $1 million of equity, now when I sell the property and walk away, I'm probably walking away with 960, 970 after closing costs, right? But that equity that I have in the first property has to be carried over into the new property, and not a lot of people understand that part.
That's a great point. I think they think about one or the other, right? They don't really focus on both. Ryan, I think one of the things that a lot of people don't do is they don't plan, right? Now you delivered, I don't know how long it was, a 2-hour session at the mastermind meeting a couple of weeks ago. Not just on planning, and I know, and I'm just going to ask you this as an investor, as I kind of segue through this question. How often are you looking and planning your personal portfolio and your personal tax strategies personally, not for clients?
I mean, I'm a little different because I'm an outlier, but every 3 months at the latest, months maybe.
And what do you advise your clients to do?
I think an average client could probably do it themselves twice a year.
Twice a year.
Twice a year.
For
At the
those
bare
of you
minimum.
and 100%. I mean, I'm doing it almost quarterly. I mean, I miss a couple of quarters based on travel and stuff like that. But if you're a person that's investing once or twice a year, you have to know that before you go make that next investment, right? Of what that strategy is going to be moving forward. And I think a lot of people miss that. So that kind of segues me into, I'm Joe Schmo. I have one short-term rental. I'm going to turn a profit on that. So I'm going to have some net cash gain on that. I have a W-2, and I only meet with my CPA on April 12th to file my taxes on April 15th, right? I go to H&R Block or TurboTax or whatever. What should I be thinking about between now and the end of the year to be able to take action to defer some of my profit off of my short-term rentals or even my W-2 if I'm not that tax line? Just at the remedial level, what do I need to be thinking about right now?
Yeah. So a lot of people make the mistake of thinking that working with a CPA or having your tax return filed by a CPA means that they're going to also be, advising you and strategizing with you on how to save money on taxes. Well, the thing with taxes is if you wait until January, February, and once the year is over, the year's already over. It's too late for you to be able to plan. Versus if you're going into September or October knowing that you're going to be making good money or you're going to be selling a property at a gain, you have a couple of months in order to work with a strategist to save money on taxes. And it's very timely because you can think of it like football. So whenever we lost over the weekend, we used to have this thing called Monday morning quarterbacking, because when you lost on Sunday, coach came back in the locker room on Monday telling you all the reasons why you lost, all the things that we could have done better. But instead, we should have known better before we went into the game of all the ways we could have used or done, all the plays we could have ran to win the game, right? So that's the difference between a Monday morning quarterback, somebody telling you what you could have done or should have done, and instead having a better offensive coordinator to run better plays. And that offensive coordinator is your CPA, is your tax advisor, somebody that can help you proactively plan for taxes. That's the easiest way to explain it.
There's also a pretty big difference between a standard CPA and a tax advisor or a tax consultant. Wouldn't you agree?
Yeah.
And you're both, which is very uncommon. You're both with and being an expert in the short-term rental loophole, which is very uncommon. So what is some of the things if somebody's, just used the same CPA for the last 12 years, Ryan, and they don't fully understand the STR loophole, what are their options?
Yeah, so we've seen this a lot recently. I know in corporate America, everybody job hops every 2 to 3 years because they can earn a higher salary by switching over to a new job. It's also the same thing with financial advisors. It's also the same thing with CPAs because they've known your situation for a couple of years, but there could be blind spots that they're not aware of. We had a client, and I'm not going to say her name, but her, Jenny, who had a CPA for their businesses, and they had no idea that the short-term rental loophole existed. Well, come to uncover all these years of missed opportunities in tax returns, we were able to amend her returns and save her over $100,000 just on the 2 properties that she bought, where her CPA didn't know that they could use the rentals to offset some of her businesses. And so that's where you're working with a CPA for so long. There's blind spots that they have if they're not real estate focused, especially if you've owned a business for a while or you've had a W-2 for a while and you're just now getting into real estate. It might be just like it's time to change jobs and earn more money. It also might be time to change your financial advisor or your CPA.
I couldn't agree with you more. Roman asked if he can schedule a call with you. Roman, just DM. You can see right there by Ryan's name at Learn Like a CPA. Just DM him on Instagram, and I'm sure him or somebody from his team will be able to connect with you to get that set up for you. And I don't want to turn this into a sales pitch, Ryan, but I know a lot of people have thought that I'm too advanced, so they don't think about my coaching programs. And a lot of people think that you are too expensive or you're too advanced for them if they only have one property. And I know you just launched a new program for those people that's extremely affordable, that includes tax coaching as well as filing tax returns. For those that are struggling out there with what we just talked about, can you just quickly describe what you do inside of that program for somebody like Roman that's asking about this?
Yeah, so my goal is to build the number one community for real estate investors to learn how to save money on taxes, right? So not only in addition to getting your tax returns filed,
I'm going to interrupt you
timely
for a
and
second,
accurate.
Ryan. I'm going to interrupt you for a second because you just fucking said a word that I think is more valuable than you filing a tax return for somebody, and it's
Mhm.
community. Explain before you go in and talk about everything past that word. I don't want you to glaze over that. What does that mean to you, and what does that mean to somebody that joins your program?
Yeah, so a community is a place where you can go to get to first help people that need your specific skill set and advice, but also get the help that you need. So in joining a community, you could think of it like old modern tribes. Tribes, they had, there was a leader of the tribe, there was the people that scavenged for food, and there's people that went to hunt, but they all worked in the same tribe or same community. And so inside of the community, we're going to have people that you can connect with, realtors, lenders, lawyers, insurance agents, We're going to have so many people inside of this community. It's going to be beyond just getting your tax return filed, but it's going to be a community of people that are going to help you think smarter about your taxes and your finances. And my goal is to build the #1 community for real estate investors.
So everybody, Ryan's going to get pretty close to achieving that. He's going to end up being number 2 right behind my community, but we'll battle for that. There's a reason that I bring Ryan on to do this stuff. There's a reason that I do Market Mondays. There's a reason I built the super team. There's a reason I have my inner circle with like what Ryan all just said. And I'm going to give you guys here that are listening today a sneak peek. Ryan is actually migrating over from the super team to become a coach inside my inner circle. And it's as Ryan and I both believe in community. That's why we give so much away. That's why I'm doing B&B camp. If you guys haven't signed up for B&B camp, you'd be insane not to come because I'm paying for everything. It's 100% free for 2 days in Whitefish, Montana. Ryan, so what else outside of the community? And I apologize for interrupting you, but I think that's the most valuable component that people don't understand. Outside of that, what happens inside that program?
Yeah, there's a ton of everything that I've ever created and either sold or given away. It's inside of that community. So if you are, a real estate agent, we got the real estate agent playbook. If you're a healthcare professional, we got the healthcare professional playbook. Even if you're investing in real estate, but you also have a full-time job or a gig outside of that, we have every single strategy or every single financial concept that you can think of that's going to either save you money on taxes or make you more money, point blank, period. And so no matter what walk of life you come from, we know and we have the strategies inside of there that are going to help you save money on taxes.
So Ryan, can you pop your email into the chat for everybody that's asking to meet with you? And then I'm also going to put in the chat, I still have about 31 tickets left, folks, for my B&B camp. That's 100% free with Pace Morby, Jerry Norton, Patrick Switek, Kenny Bedwell, Jake Cohen, Revenue Management, myself. This is going to be free. There's going to be 250 people in Whitefish, Montana, October 12th and 13th. And it's going to be unlike anything you guys have ever experienced, unless you've been to one of Pace's community camps. It's going to be pretty insane. And we will be talking about, unfortunately, Ryan has a prior commitment, so he can't be there, but we will be discussing some tax strategies. Ryan, you talked about tax planning and retirement planning at my mastermind meeting a couple of weeks ago. And I think a lot of people overlook that as well. So how does the tax planning today affect my retirement planning of the future? Can you kind of tie those two together for us as we're, in the almost into the fourth quarter of 2024?
Yeah, the fourth quarter at the end of the year is where you're going to make all those decisions when it comes to your retirement accounts. So with the retirement accounts, I know a lot of people shy away from retirement accounts. Dave Ramsey loves his retirement accounts. Kiyosaki hates retirement accounts. He says, get all your money out and put it into real estate. But the smart investors that I know, and me personally myself, I got a little bit in both. I'm in both camps. I'm drinking the Dave Ramsey Kool-Aid. I'm drinking the Kiyosaki Kool-Aid. I'm just not buying silver or gold like he wants us to buy. So here's the thing with retirement accounts. The way that I see it is they only exist if I screw everything up. Okay. If all my real estate, if I lost all my real estate, if I lost all my businesses, the reason why I use retirement accounts is because I know that my 55-year-old, 60-year-old self can sleep at night knowing that I have a certain amount of money in that account. And that number is what I call the financial independence number. And it's inside something that I call the financial freedom playbook. Because here's the thing. Every single person here has a number. It's a number they have to put in a retirement account per month in order to have that nest egg when they go to retire. So the number is $2 million. Okay. Well, you need to put $400 a month into a retirement account every single month in order to have that nest egg. But then above and beyond that, I'm trying to buy my financial freedom quicker. So if my financial freedom number is $400 a month and I make $2,000 that month, the other $1,600 is going towards buying real estate, buying other businesses, accelerating my financial freedom and achieving that quicker. So I'm not just in retirement accounts. I'm not just in real estate. I'm in both because that's the smart thing to do, in my opinion.
I couldn't agree with you more. And I think it's funny. So I just got back from Montana late last night, getting everything ready for B&B camp. And I met with, I went to Jerry Norton. Do you know who Jerry is? Flipping Mastery on.
Yes.
He's one of the biggest wholesalers and flippers in the industry in the country. And I went and did a walkthrough at his house to help him prepare to Airbnb it, because speaking of taxes, he lives in Puerto Rico for 6 months and 1 day and has all of his income and everything happening in Puerto Rico. And he said something. I posted this yesterday, I think, on my Instagram about slow, medium, and fast money. Right. So, and I'm sure you understand that concept about slow, medium, and fast money. And it sounds to me like, as you're going through what you just said about retirement planning, that kind of his model of slow, medium, and fast money applies to almost kind of how you're investing, right? Because something for me, like I've almost never put any money into a SEP, I mean, or a Roth IRA or anything like that, because I have always got better returns investing into myself. And I just recently, about 4 years, right at the beginning of COVID, started putting into retirement accounts and stuff like that. So what is an average Joe, that maybe makes $300,000 a year household income? They don't live in California. Maybe they live in a state that's a little bit more favorable from a tax perspective, and they can save $75,000 a year, right? So, I mean, does all 75,000 of that go, do they put their first 7,000 into the Roth, and then putting it into the stock market and VOO and Vanguard and that type of stuff? Or do you have a percentage that potentially should be broken down? And I'm going to give you my answer. I'm not going to give you my answer, but I think a lot of people are going too heavy into real estate, Ryan. They're putting 100% into real estate, right? And so kind of what would you, and I know you're not a financial planner, but you're also half my age. I think you're 26 now, right?
Yeah.
And I'm 51, and the strategies are different for me now than when I was your age. So how do you, and I know people come to you for this type of life planning advice. What are you advising them?
Yeah, I always want to play offense and defense at the same time. So there's a reason why the government only lets you put $7,000 a year in a Roth IRA. It's the same reason why they only let you put a certain amount of money in a 401k every year, because they understand that it is a super powerful wealth building tool. So somebody who's able to save $75,000 a year, I would say that first 7K, they should fund a Roth IRA with that
100%.
money. Because here's the thing about the Roth IRA that a lot of people don't know is you can always get the money that you contribute tax and penalty free back whenever you want. You can, if you put it in early in the year and you, for whatever reason, needed it to do a deal later on, you could always withdraw that money tax and penalty free. Now, you're shooting yourself in the foot, because that money could have been worth so much more in the future, tax-free, growing tax-free. But that's the baby step, right? Check those boxes, play offense and defense at the same time. Now, another thing could be, okay, if I can save 75 grand a year, maybe it's $7,000 in the Roth IRA. Maybe I got another $5,000 to $10,000 building up my emergency fund. Okay, then I'm gonna go look for a property, my first investment property or my second investment property. And if you buy the property, great. If you don't find something, maybe that's when you go back to some of those other retirement accounts, or you fund some of those other accounts, just so your money's not sitting there in a bank account. Because the two biggest killers of wealth, number one, taxes. Okay. If you hold on to the money, you're going to get taxed. The second biggest killer of wealth is inflation. Not only did that money that you just made get taxed, but it's also sitting in a bank account. Maybe it's earning you 4 or 5%. And that's what the government tells us inflation is, 4 or 5%. But if you look at the price of milk, oil, gas, eggs, we know it's really like 12 to 15%, depending on the type of product you're buying. But taxes and inflation, right? I don't want to get taxed on the money. So I either need to spend it on real estate, or I need to put it in retirement accounts. And I don't want to lose value to inflation. I don't want it to just sit in a bank account only earning 4%. So my best thing to do with that $75,000 is to invest it into something. Invest it in a retirement accounts, invest it into real estate, and more importantly, invest it in yourself. Because the SME 500 has a way higher return than the S&P 500.
That's why I invest in, SME. But here's the thing. I think I would put one in front of those two, and it's waiting. You wait too long to start saving, right? So you're 26, and I met you when you were 23, almost 24. When did you start maxing out your Roth IRA? At what age?
21.
21. How much money do you estimate you will have when you retire at 50, 55, 61? Let's just say 60 years old. What do you think you will have in that account?
Just in the Roth IRA is probably close to 4 million, 4.5 million.
Let that sink in, everybody. $4 million at $7,000 a year. He started at the age of 21. He retires at the age of 60. That's 49 years and $4 million. I think the biggest thing is people wait. I think people wait to buy real estate. I think they wait to start maxing out their Roth IRA. And then whatever this lady's name is, and Zanusa 53, I was going to ask you this question. They wait till they make too much fucking money and then they can't even qualify. So, I mean, I can't put any money in a Roth IRA anymore. Right. So I've got to figure out a different way to be able to do that. But based on like what you have said, I think most people should be taking care of their kids as much as they should be taking care of themselves too.
Well, that's why. What does the flight attendant on the airplane say? Put the mask on you first before you help your kids or help other people, right?
Yep, 100%, 1,000%. JT asked about the backdoor Roth. How does that work?
So our government loves to make things complicated, as they do. And so when you do earn a certain amount of money, I want to say if you're single, it's over 140, and if you're married, it's over 200,000. But you can't contribute directly to a Roth IRA. Now, fortunately enough, there's a thing called a backdoor Roth, and the process of that, how that works, is you just contribute to a non-deductible IRA. You could do a Vanguard, Charles Schwab, TD Ameritrade. I personally use Vanguard for everything, but feel free to use what you want. So you contribute to that non-deductible traditional IRA, and you typically wait about 4 to 5 business days, and then you convert it to a Roth IRA, and then you have to fill out a form at the end of the year on your tax return telling the government that you did the conversion. So it's just another step that they put in place for us, and they make that's part of the reason why half of America is broke and not enough people have enough money to retire, because they come up with all these complicated accounts. I mean, we got HSAs, 401ks, IRAs, SEP IRAs, all these different types of accounts. It literally should just be a traditional and a Roth, and every person, no matter what you do, can put the same amount of money in it, but they make it complicated for no reason.
I agree 100%. I think that is probably the most undervalued thing that we have available to us as Americans, especially over time. I'm just going to reiterate, if anybody's joining, Ryan started maxing out when he was 21. He's now 26. He estimates if he retires at 60, he'll have $4 million. I started doing it for my girls when they turned 10, is when I started maxing out for them. My oldest daughter, Gentry, is, she's got, I think, like $71,000 in her Roth. She's 18. She's going to be 19 in 2 months, right? What the fuck do you think that's going to be worth when she's, 60? Probably maybe 6 million. So those are the things that I think become really important. As Ryan said, you got to take care of yourself first, then take care of your kids. I think that is super important. Ryan, we've got 2 minutes left. What's your big tax tip for everybody here between now and the end of the year, or next week when we come back and do Tax Tuesdays again next week?
Biggest tax tip is to just identify what you're already doing, that you can either, there's a tax strategy for that, or you can learn about a tax strategy that you should be doing. So for example, like one of the biggest things that people don't know is you can actually donate appreciated stock from your brokerage account to a charity or a church, the same deduction that you were normally writing cash or a check for. You can donate appreciated stock so you don't have to pay capital gains tax, and you get the same tax deduction that you would have got if you just wrote a check for it. So it's things like that where you're already buying the rental property, you're already starting the business, you're already investing money in a certain area. And you just have to understand what are all the strategies that you can do to maximize that opportunity.
That is awesome. I did not know that. I just took a note.
Oh my God. Okay.
No clue. So I could sell, 50 shares of Tesla stock, as opposed to writing a check, right? That's
yeah.
Great.
Yeah. And then I have a podcast on it. You can check out Learn Like a CPA show. But eventually what happens is over time, so let's say this is your cost basis of the stock. Let's just say it's $500,000 and your fair market value is $1 million. So if you sold it, you'd have a $500,000 gain that you have to pay taxes on. Well, you're donating off the top of that. You're taking away from the fair market value, and the same money that you wrote a cash or check for, you put it back in a brokerage account. So your cost basis is rising and your fair market value is going down. And then eventually you can sell the whole thing tax-free.
Awesome. Great stuff. Ryan, great to be back on Tax Tuesdays.
Oh, yeah.
Thanks for joining me today. What do you have planned the next week?
I'm actually doing a meetup tonight in Chicago. We got 80 people registered. Meetup Chicago, Brownstone Tavern, and it's outside of Wrigleyville. I'd love to see you guys if you're there.
Wrigleyville, that's a good spot now. They've gentrified that whole thing. That's awesome. So go check out Ryan's meetup. Those of you that are coming to the Orlando boot camp and the Smokies, I will see you next week. Actually, Orlando and New York next week. And then I put the B&B camp link in here if you guys want to come and hang out with a bunch of my friends in Montana. 100% free on me. Ryan just popped in his email address. It's hello@retaxprep.com, or you can connect with us on Instagram. If you're watching on Ryan or my YouTube channel, make sure you smash that subscribe button. We'll see you guys next week on Tax Tuesdays.